Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today, we're diving into a proxy statement, so get ready for a look at who's running the show and how they're getting paid. Hopefully, it will be a fun watch. Let's start with the big picture. This document is a notice for Hancock Whitney Corporation's annual shareholder meeting in April. It's basically a report card and voting guide all rolled into one. The main goals of this meeting are electing directors, approving executive pay, and ratifying the company's choice of accountants. In 2024, Hancock Whitney had a pretty good year. The company made $5.28 per share, which is better than the $4.50 they earned the previous year. They managed to grow fee income, basically money they make from services, and keep expenses relatively stable. This all shows that they were able to control costs and reinvest wisely. The bank also looks to be in a solid financial position. Their capital, which is like the company's savings account, is strong, and they have a good handle on potential loan losses. The board even approved a dividend increase, which is basically a thank you payment to shareholders. So all things considered, it was a positive year for the company. There are also some changes to the company's leadership. They appointed Moses Fejan to the board and are nominating Albert Williams as a new director. One board member, Hardy Fowler, is retiring after 15 years of service. These changes signal that the company is actively refreshing its leadership to bring in new perspectives. Now, let's get into the specifics of the shareholder meeting. The first proposal on the table is electing 6 directors to serve for the next 3 years. The board is recommending that shareholders vote for all 6 nominees. Directors are crucial to a company because they guide the strategy and make big decisions. Next up is an advisory vote on executive compensation. This is where shareholders get to weigh in on whether they think the top executives are being paid fairly. It's non-binding, but it gives the board a sense of what investors think. The third proposal involves an amendment to the company's long-term incentive plan. They want to increase the number of shares available by 1,300,000. These plans are intended to reward employees for sticking around and hitting long-term goals. Finally, shareholders will be asked to ratify the selection of PricewaterhouseCoopers, also known as PwC, as the company's independent accounting firm for the year. The accountants are essential for helping to check financial statements, so having an independent third party is critical. Alright, now let's move into the proxy statement summary. The annual meeting will be held virtually, where shareholders can attend online. If you own stock on February 28, you're eligible to vote on these proposals. The company is using electronic delivery of these materials to save on costs and resources. Hancock Whitney's financials show a stable bank. They had just over $35 billion in assets at the close of the year. While their loan portfolio decreased somewhat, that is part of a larger strategy to reduce risk. The company also had a good handle on deposits, keeping the amount of deposits similar to the year prior. Looking at corporate governance, the company has some good practices in place. Most of their directors are independent, meaning they're not employees of the company and can provide unbiased oversight. They are trying to diversify their board and maintain open communication with shareholders. This is a good sign because it shows the company values accountability and different points of view. When it comes to executive compensation, there are some checks and balances in place. A good portion of executive pay is tied to performance, meaning they only get paid if the company does well. The company does not have any golden parachute deals with executives, so that helps to protect shareholder interests. The report highlights the backgrounds of all the director nominees. They have a wide range of experience in industries like utilities, transportation, and technology. Some of the key skills mentioned are federal regulation, strategic planning, and knowledge of the Gulf Coast markets they serve. This diverse expertise is valuable for a company operating in a complex environment. The report also states that all required filings by executive officers and directors were made on time, except for one late filing due to an administrative error. The board has a number of committees that help in running the business. These committees range from risk management and compensation to audit and nominating. Each serves a specific role that can involve risk assessment or financial planning. Directors are paid through a combination of cash retainers and stock awards. This helps to align their interests with those of shareholders so that they are incentivized to help grow the company over the long run. They also have stock ownership guidelines, which means they are expected to own a certain amount of company stock. Looking into the biographies of the current directors, we see they have a wide range of backgrounds and experience. The board appears to value fresh perspectives, as several directors have been appointed in recent years. They also emphasize ongoing training to ensure directors stay up to date on relevant issues. The compensation discussion stresses that the company's pay philosophy is based on performance. They want to reward executives for achieving both short-term and long-term goals and align their interests with those of shareholders. Key metrics the company uses to measure performance and give raises and bonuses include adjusted earnings per share and pre-provision net revenue, along with credit quality. The CEO's pay compared to the median employee is about 76 to 1. That's a pretty wide range, but that is still smaller than other companies of this size in the United States. Finally, shareholders are being asked to approve an amendment to the company's long-term incentive plan to increase the number of shares available by 1,300,000. This plan helps attract and retain key employees by incentivizing the stock. PwC was selected as the company's independent auditor. They review financial statements and maintain a high level of standards. The audit committee says that they have selected the right fit for what Hancock Whitney needs. Overall, Hancock Whitney seems to be a well-managed company that is focused on long-term growth and shareholder value. Their strong capital position and strategic approach to risk management are positive signs. However, potential investors should pay attention to the bank's loan exposure, especially in the current environment. In conclusion, this proxy statement offers a pretty good overview of Hancock Whitney. By voting, it gives you a chance to influence the company's direction and ensure it continues to act in the best interests of its shareholders. Thanks for watching. If you found this video helpful, please like, comment, and subscribe for more deep dives into the corporate world.